So transferring properties into a limited company, explained in simpler terms so you understand. We've had a few calls off of you asking questions, and this is how it works. When you own a limited company, you can transfer assets from limited company to limited company. No CGT, no SDLT. But when you transfer from little man into limited company, it goes from personal name into a limited company, so your tax is due unless you do it as what is presented as a business. So man and man, or let's go man and woman for any of you that want to complain about the man and man situation. They own properties together, they're working it, it's a business, it's active. At the moment, you're putting it on your tax return as income from land and property. It needs to show as income from partnership. So you do a family partnership, forget that, yeah, agreement. Anyway, back to this, right? So family partnership, very simple agreement, gets written by the accountant or a solicitor. Better to go to the accountant because they've got probably got plenty of them in their side drawers. They won't charge a fortune for. They're going to set up a partnership agreement. They're going to file your tax return, and they're going to say, that the income is now from partnership as opposed to income from land and property. It's now a business. It's presented as a business on your tax return. So that tax return comes in, the second tax return comes in, and now you as a business have evolved and you wish to be a limited company. So you then incorporate into an LTD. So when you become an partnership, so you're now a partnership, you are going to incorporate. Once you've done the incorporation, we borrow the mortgage in the limited company's name. That money pays off you guys and the property goes into the limited. The money that goes in here, let's say it was a loan to value of 75%. Anything left in that property is a director's loan because your directors, that money's got to come back to you. If you, in your partnership, let's say your loan to value was 50%. And then you moved it into the limited company and the money you borrowed was 75%. That's your money back tax-free to do as you please. I might get that bit wrong, so it'd be nice to see anyone come back at me with a bit of information there. But my understanding is as long as if it's your money, you can take it out of there to use for business purposes. What those business purposes may be, don't know. You might buy yourself a sports car, who knows? You might have to go on a cruise as a director, whatever. Right, so yeah, so you take now the other 25% director's loan account, it belongs to you. You can draw that money out of your account. You can draw it out of that account tax-free as well because that money belongs to you as one of the partners whose property's assets shifted into the limited company. It's your money, you can have it out tax-free. I hope that kind of explains things better, but if you don't understand, you know where we are.